Hi friends, welcome back to the channel. Today we are going to talk about something that just passed, Hyundai India's IPO. Now Hyundai has been part of our lives for over 2 decades and it's so surprising that its IPO struggled to attract investors, especially when so many unknown companies are getting listed with big premiums in the grey market. In fact, Hyundai's grey market premium was just 0.4%. Without wasting much time, let us see why there is such a low investor enthusiasm for the stock at present. I believe there are 3 key reasons for this and which I'll try to break down for you in this video. By the end of this video, you will have a clearer idea whether to invest in Hyundai once it gets listed, and if you're investing, when should you jump in to maximize your returns. The first reason why people are upset or even a bit suspicious is because IPO was fully priced and it was all offer for sale, OFS, that is no fresh issue of shares. Being fully priced created an impression that promoter Hyundai Motor Company of Korea was trying to grab all the money right now, leaving nothing on the table for the retail investors. After bumper listing of Bajaj Housing Finance, Ola Electric and Premier Energies with immediate gains for the subscribers, this was quite disappointing, right? And since there is no fresh issue of shares, Hyundai India doesn't receive any funds from this IPO either. The fact that the parent company Hyundai Motor Company from Korea is the sole beneficiary of this IPO is understandably frustrating for many of us. But here is something that is important to remember. Hyundai Motor Company has always owned 100% of Hyundai India. So whenever a Hyundai car is sold here, the major financial beneficiary has always been Hyundai Motor Company. Now let us talk about major ways the Hyundai Motor Company benefits from its subsidiary in India. First, we have royalty payments. So whenever a Hyundai car or SUV is sold here, part of the revenue goes to the parent company. Currently, this royalty fee is 3.5% of the revenue, but it has varied over time. For example, it was 2.39% in fiscal year 2022 and 2.23% in FY24 before increasing to 3.5% in fiscal year 2025. And it could go even higher tomorrow. Maruti paid up to 5% to Suzuki, especially when the new models were being released. In FY23, Hyundai India paid nearly 14,358 crores in royalty payments to its parent company, which is a 30% increase from the previous year. Besides royalty, dividends are another way Hyundai Motor Company benefits. Last year, Hyundai India paid 10,782 crores in special dividends to its promoter. This is a hefty increase compared to the 4,653 crores that was paid in fiscal year 2023 and just 1,493 crores that was paid in fiscal year 2022. So even before the IPO, the major portion of the Hyundai India's financial gains have been flowing back to its parent company. While this may be frustrating to retail investors, it's important to note that this has been the structure from the very beginning. Hyundai India has always been 100% owned by the parent. But it's not all one-sided. Hyundai India also benefits tremendously from its parent company's global resources. Let's dive into that next. Now, before we criticize Hyundai Motor Company for taking profits during the IPO, it's important to recognize how much Hyundai India benefits from its parent company. Firstly, Hyundai India receives massive support in terms of product planning, design, and manufacturing. But what really stands out is the access it gets to Hyundai's global R&D efforts, which is absolutely critical in today's competitive auto market. Hyundai India's parent company, Hyundai Motor Company, has invested an incredible $24.6 billion, that is nearly 2 lakh crores in global R&D efforts between 2014 to 2023. This investment focuses on areas like electric vehicles, self-driving technology, and shared mobility, all emerging markets that will define the future of the auto industry. And it doesn't stop there. Hyundai plans to invest another 41.8 billion or 3.5 lakh crores in the next 6 years with the aim to become one of the top 3 EV manufacturers in the world by 2030. So how does this benefit Hyundai India? Well, apart from having access to the cutting-edge R&D, Hyundai also benefits from the brand's global recognition and the sales network. Hyundai India is the second largest exporter of passenger vehicles in our country. Since its inception, Hyundai India has exported nearly 36 lakh vehicles to over 150 countries. It is a key production and export hub for Hyundai's emerging markets. Now let us get back to the offer for sale structure and its size. The size wasn't just a decision made by Hyundai. It was dictated by the SEBI regulations that require that 25% of a large company's shares must be held by the public. In this IPO, 17.5% of the shares were sold, but SEBI rules state that within the next 3 years, Hyundai Motor Company will need to reduce its stake by another 7.5%. This will bring their total shareholding to 75%, ensuring compliance with public shareholding requirement. There's another positive way to look at this IPO. Since it's a pure OFS, it means Hyundai India doesn't need your money to fund its operations. The company is likely in good financial health, and that's why there is no fresh issue of shares. In fact, Hyundai India has generated strong profit over the last 3 years. 6,060 crores in fiscal year 2024, 4,709 crores in fiscal year 2023, and 2,902 crores in fiscal year 2022. And Hyundai India has big plans ahead. The management plans to spend about 32,000 crores on capital expenditure over the next 10 years. Given that the company has generated over 14,000 crores in profits in the last 3 years alone, this capex should be comfortably covered by the cash generated by the company. However, some analysts have raised concerns about the dividends that Hyundai India has been paying out to its parent company. Over the last 2 years, Hyundai India paid over 15,436 crores in dividends, which has significantly reduced its cash reserves. This could mean that Hyundai India might need to take on debt to fund its expansion plans. That said, the company still has about 9,000 crores in cash reserves, and with continued profitability, they might be able to fund expansion without too much trouble. So Hyundai India is in strong financial positions, okay, but what about the market share? The second major reason why there was lack of enthusiasm around Hyundai's IPO, the declining market share of Hyundai in India. Hyundai India's market share dropped from 17% in fiscal year 2021 to 15% in fiscal year 2024. And one of the key reasons for this is the rise of SUVs as the preferred choice of Indian consumers. This shift in consumer preference has led to aggressive growth by domestic players like Mahindra & Mahindra and Tata Motors. The Tata Motors market share has jumped from just 5% in fiscal year 2020 to 13% in fiscal year 2024, driven by the success of its SUVs like the Tata Punch and Tata Nexon. And this was also supported by its EV lineup, where it has a dominant market share. Meanwhile, Mahindra & Mahindra has also seen similar growth, climbing from 6% in fiscal year 2021 to 11% in fiscal year 2024, thanks to the popular models like XUV 300, XUV 700 and the Scorpio N. But here is something interesting. While Hyundai's market share has declined, its sister company Kia has been making strides. Since its debut in India in 2020, Kia's market share has grown to 6% in fiscal year 2024, and its popular SUVs are in direct competition with those of Hyundai. So while Hyundai may have lost some ground, but it's important to note that Kia's success also reflects well on the overall Hyundai group. In spite of all this competition, Hyundai still holds a strong position in the mid-size SUV segment with a 38% market share, thanks largely to Hyundai Creta, which remains one of the most popular SUVs in India. In fact, 67% of Hyundai's revenue comes from SUV sales. So it's clear that Hyundai is very much in the game when it comes to SUVs. And let us not forget Hyundai's focus on the future, that is the EVs. Both Hyundai and Kia have been making waves with their electric vehicles. For the last 3 years in a row, Hyundai Ioniq and Kia EV9 have won the Car of the Year award at the World Car Show in New York, beating strong competition from the likes of Tesla, BMW, Volvo and Ford. As I mentioned earlier, Hyundai has committed a massive 3.5 lakh crores in capital expenditure to its vision of becoming one of the top 3 EV manufacturers in the world by 2030. So even though Hyundai's market share has taken a hit lately, the long-term growth prospects still look very promising. Alright, so now that we looked at the market share and future growth, let us talk about the valuation part of the IPO. Is it fully priced, or what does that mean for potential investors? Let's find out. The third major concern with the Hyundai IPO was the valuation part. As I mentioned earlier, this IPO appears to be fully priced, meaning there isn't much room for quick gains that Indian investors have become accustomed to with big IPOs. As said earlier, recent offerings from Bajaj Housing Finance, Premier Energies and Ola Electric brought substantial profits to investors post-IPO, but Hyundai's promoters didn't leave much room for short-term investors who want to make quick profits from their allotments. So here is where it gets interesting. Even though Hyundai India's revenue only accounts for 7 to 8% of the global parent company's total revenue, it was priced at a valuation of 1.59 lakh crores, which is nearly 42% of the global parent company's total market cap of 3.72 lakh crores on the Korean stock exchange. So why the big difference? Well, the parent company's PE ratio is just around 5, while Hyundai India is being priced at a PE of 26. This might seem high, but there may be a reason to it. India is still very much a growth market. Car penetration here is only 2 to 3%. Compare this to 50 to 80% in the developed economies where the parent company operates. To give you a better idea, car ownership in India is just 25 cars per 1,000 people, while in South Korea it is 530 per 1,000. And in the US, it's a whopping 860 per 1,000. So clearly there is a lot of room for growth in the Indian market. Another factor to consider is something called Korean discount. The P ratios of Korean giants like Samsung, LG and Hyundai have traditionally been about 30% lower than their global peers. So you may ask me why? Well, this discount comes from a mix of concerns, including corporate governance issues, the dominance of family-controlled business structures, ongoing tensions with the North Korea, restrictive government policies, and lower dividends that were paid to the investors over a period of time. The fact is that Hyundai India's PE ratio is 26, and this is slightly below Maruti PE's 27, and it shows that Hyundai India's IPO is fully priced, of course, leaving little to no immediate upside for retail investors. Many analysts even suggested waiting for a dip before buying, especially since the stock could be available at lower prices after the listing. Given that this was a large IPO, it is expected that many sellers could offload shares on the listing day or within the first week itself, which could drive the price of the stock down. Also, Hyundai has already raised 8,315 crores from anchor investors, with 4.2 crore shares allocated at the upper price band of 1,960. And here is why that matters. Half of these shares will hit the market in a month and rest will follow in 3 months. And when these shares are sold in bulk, it could put downward pressure on the stock price. And don't forget the mandated share sale. Over the next 3 years, Hyundai's parent company will need to sell an additional 7.5% of its shares to comply with the SEBI regulations. This could bring the price down even further. On the brighter side though, Hyundai is practically debt-free and has posted good growth numbers over the past few years. From FY22 to FY24, Hyundai achieved a CAGR of 19.4%. In fiscal year 2022, growth was 15.4%. In FY23, it jumped to 27.29%, and in FY24 it was 15.79%. Of course, some of this growth can be attributed to the stunted growth during the COVID years, but still it is a positive sign. So what is the majority opinion? Hyundai India looks like a stock that could bring good returns for investors in the long run. But in the short term, the stock price may go down, which is why many experts recommend waiting and watching until the market settles before making a move. To sum it up, Hyundai India's IPO is no doubt fully priced with limited immediate upside but has strong long-term potential. If you are thinking of investing again, it might be wise to wait for a dip before jumping in. As always, do your own research and make the best decision for your portfolio. So that's it for today. If you found this video helpful, make sure you like, share and subscribe for more such videos in the future. Thanks for watching. Have a great day.